Most investors use the term risk and volatility interchangeably. This is a big mistake in my opinion. These terms do not mean the same thing, and this topic is one that not a lot of people are talking about. By the end of this video, you'll understand why knowing the difference between these two terms has a big impact on you and your investing returns. Most people would look at this chart and assume that this company is very risky. Well, it's certainly volatile, but in fact, we have no idea whether or not this company is risky. Or how about these two graphs? In the first graph, we see the stock price go up 3% in year 1, 20% in year 2, and another 10% in year 3. A different stock goes down 10% in year 1, 10% in year 2, and another 10% in year 3. But you can rest easy because this stock has a risk-free return, negative 10% per year every year. But seriously, I hope that looking at these two charts might get you to think that there's a little bit more that goes into all of this. Roughly speaking, there are two main factors that contribute to whether or not a company is a good buy: the core business and valuation. First, let's tackle understanding the core business. To get us thinking in the right direction, I'll ask you a few questions. Does the company have strong brands? How long has it been around? How easily can market share be taken by competitors? Are there barriers to entry in the industry? Does the business have few large customers or many small customers? Does it operate in a growing industry? How likely is the industry to be disrupted by competition? Does the industry have large or small profit margins? Does it generate revenue via subscriptions, one-time purchases, or is it a pay-as-you-go model, or maybe something else? These questions and many others can be answered by reading the beginning of a 10K, which can be found on the investor relations page of any company. One of the best parts about being a retail investor is you can use your own intuition and observations to direct you in finding good companies. Now, it's not a good idea to just buy the company Nike because you like wearing their shoes, but having a qualitative understanding that the shoes are good and a lot of people out there in society enjoy wearing them, this is a great start in determining whether or not a company may or may not be worth even looking into. In fact, Peter Lynch, one of the greatest investors of all time, has mentioned that he often got stock ideas from just watching what his wife and daughters brought home from the mall. Analyzing a business has a lot of different components to it. I don't want to make it sound like a person can easily learn everything there is to know just from watching a short YouTube video. But you don't have to have a fancy business degree or live in New York City to know how to do it either. Understanding a core business is all about reading and understanding information that's available to you as an investor, eliminating your biases, and knowing where the company is now, where it's likely headed in the future, and understanding some of the risks that the company is going to encounter along the way. The second component to determining if a stock is a good buy is valuation. Valuation is just a fancy way of saying how expensive a stock is. I'll give you an example. Let's say you're at a store and someone says, "Hey, this beef over here is very cheap. It's only $5. Do you know if it's a good deal? It's $5, but 5 what? $5 per pound, per ounce, per gram, per kilogram? Unless you know how much you're paying for a certain amount, you have no idea if $5 for beef is a good deal. Valuing stocks is actually very similar. For instance, let's say a stock is trading for $50 a share. This is just like saying beef is $5. I don't know if it's a good deal, at least not yet. We need to compare it to something to give us relevant information. In the case of beef, we care about price per pound. In the case of stocks, we need to compare it to something a little bit different. There are a few different metrics that could be used, but two common ones are net income and sales or revenue. I want to know how much I need to pay for the stock to pay me back $1 in earnings. This is called the PE ratio. Or I might care about how much I pay for the stock to generate $1 in revenue. This is called the PS ratio or price to sales ratio. At a basic level, this is really all there is to valuing stocks. To recap, there are two primary factors to determine whether or not a stock is a good buy. Number one, the health of the core business, where the company is now and where it's likely headed in the future. The second is valuation. How much do I need to pay to receive $1 in net income or $1 in net sales? Now, let's return to the original graph to look at 4 possible scenarios. In the first scenario, the business is strong. It's a standout in the industry and there's lots of growth ahead. We're paying $20 for $1 of net income, or a 20 PE, and $4 for $1 in net revenue, or a price to sales ratio of 4. This stock might be a great buy. It's low risk. We're buying high quality ground beef for $2.50 a pound. In the second example here, we're buying basically the same strong business. It's a standout in the industry with lots of growth ahead. But there's no PE ratio yet because the company is still unprofitable, and we're paying $40 instead of 4 for $1 in revenue. So the price to sales ratio is 40. Maybe it's not a buy this time. It's the same company, but it's a worse valuation. Basically, I'm paying $25 per pound of the same ground beef. Same product, but a worse price. Maybe it's not a buy. Now in this third example, we're buying a weak business, mediocre in the industry with minimal growth ahead. But we're paying the same price as in scenario 1, $20 for $1 in net income and $4 for $1 in revenue. Maybe it's not a buy. Now I'm buying expired nasty ground beef for $2.50 a pound. It's the same price per pound, but I'm not getting as high quality a beef. And finally, we have the fourth example, a weak business, mediocre in the industry, minimal growth ahead, no PE because it's unprofitable, and we're paying $40 for $1 in revenue. Definitely not a buy. I'm buying expired, nasty ground beef for $25 a pound. Bad beef and a bad price. This type of company is definitely going out of business. As you can probably tell by now, analyzing stocks is all about determining if the company has a strong future and you're paying a reasonable price for it. You may have a great company at a bad price or an okay company at a good price, and they still might not be worth buying. There's a million different distractions out there, but as an investor, when we're researching, these are the two things that we're trying to figure out. So, when a company has a volatile stock price like this one, but the underlying business is solid and we're buying at an attractive valuation, we've just found that company with high volatility and low risk. Companies are mispriced all the time, and in fact, volatility is great for investors who know what they're doing and use that volatility to insulate themselves from risk by buying in at lower prices. All of what I've said in this video assumes that you're willing to hold the stocks that you buy until the market prices them fairly. This could take months and in some cases even years, but the bottom line is that if you buy good companies at great valuations, you have limited your risk. But again, if you're short-term trading or day trading, the rules are completely different. In this case, volatility is a pretty decent indicator of risk. One final point I would like to conclude with is that just because risk and volatility are not the same thing does not mean that they're uncorrelated altogether. For instance, a risky, unprofitable, speculative company is likely to have a volatile stock price, and for good reason. But the point remains, if we always assume that a volatile stock is a risky stock, we're going to miss out on great opportunities. Determining if volatility matches risk is something for each individual investor to determine. As you can see here, we're down approximately 4.5% this past week. And as far as some of the decisions that I have going forward, the only company that I'll be interested in buying, depending on how their earnings come out in early August, will be Corsair Gaming. I've decided that I've finished my position here in Micron. I'm going to hold what I have and then sell weekly call options on Micron and ride the price momentum upward once it starts to uptrend. Next, I wanted to respond to a comment that I received from Benjamin. His comment didn't show up in the actual YouTube video's comment section. I think YouTube's spam filter is a little bit too strong. It's prevented a few of your comments from showing up, so just be sure you don't have any weird punctuation or something, otherwise it might get caught up by that filter. Anyway, Benjamin says, see crash course history on the Great Depression. Deflation wasn't the cause of the Great Depression, but was a result of it. This is a great comment. Thanks for the clarification, Benjamin. I am definitely not a historian, and I do not remember exactly how I phrased it in the actual video. But the point I would like to make is that regardless of the mechanism that causes the deflation, for example, if we were to experience deflation, as Kathy Wood suggests, it's not that deflation caused COVID or any of the other things that have been going on in the market lately. Rather, the market conditions might create a situation in which the deflation might occur. and that if we enter a deflationary spiral, that is definitely going to be a negative thing. So regardless of whether or not deflation is the cause or effect of a certain set of circumstances, the point is that if we experience a deflationary spiral, there's always going to be strongly negative consequences. Moving on to the next comment here, Stephanie asked to discuss rolling options, and I will potentially come out with a dedicated video to rolling options in the future, but in today's video, I'm just going to show you how I rolled my Dropbox position. I did a screen recording when I decided to roll this position so that you guys could see what was going on here. So I'm entering Dropbox here on Robinhood. I hit trade options. I see the option chain. My previous option position expired July 16th, so I selected that. And it is a short call option position, so a covered call. So you can see the call slider is selected, and my position was -4 contracts, which means I sold 4 contracts here at the $31 strike price. And since I sold those, now I need to switch the slider over to buy. To cancel out or close this position, if I previously sold them, I need to buy them back to close. So I've hit select in the upper right hand corner, and you see these dots appear. I'm going to select the 31 strike call to buy them back. Then I'm going to change over to sell, move to a new expiration cycle. Here I chose August 20th. As you can see, I've selected the $33 strike price. The premium here is about 76 cents at the time I recorded, and then if I scroll back here, you can see that to close this position, it was 25 cents. I'm going to pay 25 cents to buy it back, and then I'm going to receive approximately 76 cents in order to open that new position. So even though I'm moving up in strike price, by moving further out in expiration, I'm able to still collect a credit or collect premium from this transaction. So I'll zoom forward here, and you can see the summarized position here. If I hit review, there's 4 contracts. I'm going to enter 4 here. And then I already tried executing it at 51 cents, which is the mid price. It did not fill, so then I resent it for 50 cents. And then on 4 contracts at 100 shares per contract, that gives me a total credit of $200. I submitted that. It filled exactly at that price that I set. So $200 credit there. As you can see at the top here, now it's showing my new position, a Dropbox 33 strike instead of 31. Short call option position, 4 sells, and it expires August 20th. So here's the new position. Thank you for the comment, Stephanie, and if you've made it this far in the video, thank you so much for watching. Please like the video, consider subscribing, and until that next one, peace.